Australia's tax-free threshold has been $18,200 since 2013. 13 years, no change, while the cost of living has climbed more than 40%. So it's no surprise that when people find a way to cut their taxable income, $18,200 is the number they aim at. Here's the problem. That isn't the real tax-free threshold, and even the real one is often the wrong place to stop. Get this wrong and you can hand thousands of dollars to the tax office you never needed to pay. Or worse, pay tax twice on money you were trying to protect. 2 examples today will show you exactly where the line sits. Welcome back to Aussie Retirement. I'm Jeff, and this channel exists for one reason. Australia's retirement rules are written in a language almost nobody speaks, and the people who lose out are the ones nobody explained them to. So every video takes one rule, super, tax, the age pension, and lays it out in plain English with the current figures. No jargon, no sales pitch. Hit subscribe so you don't miss out, and it helps other Australians find this channel too. 1. The real number is $22,866. Try it. Earn $21,000. Zero tax. $22,000. Zero tax. $22,866. Still zero. $1 more and tax appears. The reason is the low-income tax offset. It's worth up to $700. You get the full amount on incomes up to $37,500 and you don't apply for it. The ATO works it out automatically when you lodge. Here's the arithmetic. This financial year, income between $18,201 and $45,000 is taxed at 15%, down from 16%, thanks to the rate cut that started on July 1st. So $700 of offset wipes out the tax on $4,666 of income. Add that to $18,200 and you get $22,866. And notice what that means. Because the offset is a fixed dollar amount and the headline threshold never moves, the effective threshold only shifts when a rate or an offset changes, never with inflation. Every year, prices rise and the line stays put, which is bracket creep doing its quiet work on the lowest earners in the country. Nobody announces it. It just happens. One important footnote for anyone watching this who's over 65. If you're eligible for the seniors and pensioners tax offset, your threshold is meaningfully higher again. That offset sits on top of the low income tax offset and can lift the point where tax starts by thousands of dollars. Whether you qualify depends on your age, your income, and whether you're eligible for a government pension. That's a big enough topic for its own video. Say the word in the comments and I'll make it. 2. When hitting the threshold is easy. Sophie is at university with a part-time job earning $24,000. Believing the threshold is $18,200, she thinks she needs to find $5,800 of deductions. Good luck. Worse, students in that position sometimes buy things they don't need just because it's tax deductible, spending $1 to save 15 cents. Knowing the real number, she needs $1,134 of deductions, and most of that is now handled for her because a genuinely new rule started on 1st July. The $1,000 instant deduction. It's law, it applies from this financial year, and it lets eligible workers claim $1,000 for work-related expenses with no receipts and no logbook. 2 things to understand about it. First, it's an either/or choice. If your real work-related expenses come to more than $1,000, claim those instead. You can't have both. So Sophie's union fees or professional memberships don't stack on top. Second, you'll first use it on your 2026 to 27 return, which you lodge from July next year. It also doesn't apply to the self-employed. So Sophie takes the $1,000 and needs just $134 more from a category that sits outside work expenses. A charitable donation would do it. Zero tax. 3. When hitting the threshold is a mistake. Warren is 63 and retired. He's just sold an investment property he'd held for 20 years, and because he sold it in this financial year, before the 50% CGT discount disappears on July 1st, 2027, the current rules still apply. His gain is $386,400. The discount halves it to $193,200. Without any planning, his tax and Medicare levy on that comes to $56,674. Warren has room to move. His total super balance was under $500,000 at the 30th of June, and he's made no concessional contributions for 5 years, so the carry-forward rules let him contribute and deduct up to $175,000 this year. 6 years of caps stacked together. So the tempting question, should he use enough to drop his taxable income to $18,200, to $22,866, or stop somewhere else? Almost everyone says one of the first two. Almost everyone is wrong. 4. The rule that changes everything. Here's what gets missed. Concessional contributions aren't free. They're taxed at 15% going into your super fund. So, a deductible contribution only wins if the personal tax you avoid is bigger than the 15% you pay on the way in. That means the goal was never reduce taxable income as far as possible. The goal is net benefit, personal tax saved, minus contributions tax paid. Watch what happens to Warren below the threshold. Once his taxable income drops under $22,866, each extra dollar contributed saves him no personal tax at all, because he isn't paying any. But it still gets taxed 15% inside super. He's now paying tax he could have avoided entirely by simply not contributing. That's the double payment trap. And just above the threshold, it's barely better. In the low bracket, he's saving 15% in personal tax and paying 15% contributions tax, a wash, and the Medicare levy phasing in around $28,000 complicates it further. Between $37,500 and $45,000, the LITO starts withdrawing too, which pushes his effective rate to about 22%, a real but modest 7% net gain. It's only above $45,000, where the rate steps up to 30% plus the levy, that each contributed dollar starts delivering a genuinely worthwhile benefit. So the sweet spot isn't the tax-free threshold, it's the point where the tax you're avoiding is comfortably higher than 15%. And for most people, that means stopping around $45,000 of taxable income, not $18,200. Let's put Warren's actual numbers on it. If he contributes about $148,000, his taxable income lands at $45,000. His tax bill falls from $56,674 to roughly $4,600, a saving of about $52,000. Against that, his fund pays 15% on the contribution, around $22,200. Net result, he's close to $30,000 better off, and the money is sitting in super rather than gone. Now compare that with the zero tax version. Pushing all the way down to $18,200 would mean contributing around $175,000, the whole cap, and the extra $27,000 of contributions buys him almost nothing in personal tax saved, while costing him roughly $4,000 in contributions tax. He'd have burned 5 years of accumulated cap space to make himself worse off. That's the whole lesson in one comparison. 5. And don't spend it all at once. One more layer. Warren doesn't have to use the whole $175,000 this year just because he can. If he expects higher income years ahead, another asset sale, or income that lands in a higher bracket, cap space saved is cap space that could deliver a much bigger benefit later. Unused amounts do eventually expire after 5 years, so it isn't free forever. But the question is always, where does each dollar buy the most? 3 practical cautions before anyone copies Warren. If you're 67 or over, you must meet the work test to claim a deduction for a personal contribution, which catches a lot of long-retired people who assume this strategy is available to them. You must lodge a valid notice of intent with your fund before you can claim. And the $500,000 balance test is measured at the previous 30th of June, so it may not be there next year. Here's the big picture. $18,200 isn't the real threshold, $22,866 is, and $22,866 usually isn't where you should stop anyway. Aim at the point of best net benefit, not the point of zero tax. Zero tax feels like winning. It often isn't. Everything in this video is general information, not personal advice. Tax on capital gains and super contributions is genuinely complicated, and the amounts involved are large. Take your numbers to a registered tax agent or licensed financial advisor before you act. If you found this useful, give it a thumbs up and hit subscribe. I'm Jeff. This is a starting point, not advice, so run your own numbers before you contribute $1. See you on the next one.